Hello and welcome. Moss Adams is pleased that you joined us for today's webcast, Navigate Change with Regulatory Accounting for Utilities. Before we begin, I'm going to play our housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our slide deck and handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
We have a couple of great presenters with us today from Moss Adams. Please welcome Julie Desimone, Partner and Energy Industry Group Leader, and Olga Darlington, Partner and Power and Utilities National Practice Leader. Their bios and contact information are located in your webcast console. And now I'd like to turn the floor over to the presenters to get us started.
Thank you, Lauren. Appreciate it. Hello, my name is Julie Desimone, and I'm here with Olga today to talk a little bit about regulatory accounting. I will say during this presentation, we're definitely not going to get into the dregs of regulatory accounting. There's a lot more to talk about. But what we are going to go over today is some of the basics of regulatory accounting, talking through the understandings of the accounting mechanics behind regulatory accounting, how it can serve as a tool, so some of the tools that it can be used for during the rate-making process, also some pitfalls as we go through it, and then the idea of setting up some reserves. And this isn't for everybody, so we want to make sure that everybody understands what can and can't be done through the use of regulatory accounting. But first, we're going to go ahead and start with a poll question. Lauren?
Oh, thank you, Julie. Polling question number 1. What sector do you work in? A, private or publicly owned utility. B, public sector government utility. C, utility industry consulting entity. Or D, other, not applicable. The polling questions are located right on the slide we are presenting. If you can't see it, you can hit the F5 key to refresh on your console. To respond, please click on the button next to your answer you choose and hit Submit. Right, we'll give it a few more seconds here. All right, and here are the results.
Perfect. So we've got a lot from the municipal-owned utilities or privately owned. We're actually about even with the public sector as well. Perfect. So we'll talk through this regulatory accounting for everybody here and let you know the different standards that are in play. So moving forward, we really want to get into the basics of regulatory accounting. The other thing to note too is that there is a lot more of regulatory accounting that we can't get to in a single hour. So again, we're going to go over the basics of regulatory accounting, but please contact your service, a person that can help dive a little bit deeper should you decide to use this. So what is it? What is regulatory accounting used for? Well, primarily it's in the utility business because you have to be a regulated entity. And what that really means as a regulated entity is that you have to be one that can sets rates and have to live with those rates for a while until a regulator can change that. It is an accounting vehicle, and an accounting vehicle only used to match our revenues and expenditures. In today's world, I think for many of you that have been through accounting over the last couple of decades, it sure feels like most of our GAAP that's come out hasn't been the matching principle. It was one of the most basic and fundamental accounting principles we've always had. But there seems to be a lot coming down the pipe over the last several years that doesn't seem to match the revenues and expenditures as well. This is the one that helps us do it. It's saying if we're accumulating revenue in one period, we're trying to match those expenditures in the same period. And we can go ahead and utilize this form of regulatory accounting to help us do that. It is only applicable to enterprises with regulated operations, which is most often utilities. It's the space that we see it by far the most. Now, please note, you may have a utility that has both regulated and non-regulated pieces of your utilities, and it really comes to who regulates, who sets that rate, and how is it set. So we'll talk a little bit further into the mechanics in that, but this is only for those enterprises with regulated operations. I will say when we have somebody that comes over from like a manufacturing company or other types of entities, this does seem like a very, very strange concept because usually you can't just change your sales price right away. So once again, it is a unique to the utility primarily industry, but ultimately it is something that is allowed for both in our FASB and our GASB standards. So the guidance that we find it in is ASC 980 for our FASB followers. So those would be all your investor-owned utilities, for-profit entities, cooperatives. Those will all be under the guidance of FASB, which is ASC 980. And then the same standard, or a similar, I shouldn't say the same, they are different. A similar standard for our municipal utilities and our municipal entities is over in GASB 62. So good guidance, make sure you go to the right place to find it because there are some nuances, though I think the overarching principles are relatively consistent. There are some different characteristics in each of those. Lauren, do you want to take on the poll question?
Sure. Polling question number 2. Does your utility currently use or is considering to implement regulatory accounting? A, yes. B, no. C, we're thinking about it. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And we'll give everyone a few more seconds here to respond.
I guess we should have had a D. I didn't know what regulatory accounting, anything about regulatory accounting before I signed up for this webcast. That would have been, I just need the CPE credit, maybe E, as we're closing in on the year.
All right. And here are the results.
Perfect. Good. This would be another interesting. This would be another interesting question to ask on whether or not you're a FASB follower or a GASB follower, or if you're electric versus other utilities. I will say we've seen it much more common in the electric space than we have in the other spaces, from water to wastewater. But if you've got regulated rates, you can go ahead and use this. It's just not as well known in those spaces, but becoming more well known. Olga, I'll turn it over to you.
Thank you, Julie. All right. Well, Julie mentioned a couple of times the unique operations that utilities present. And that uniqueness comes from the defined service territory that utilities generally have because of the infrastructure that they have built out to serve their customers, which allows them to kind of have a secure customer, maintain a stable customer base, and then set the rates for the services that they provide. To ensure that customer interests are protected, the regulatory accounting has come into play, or regulated operations, I should say, which the regulations that are put in place to limit to a point utilities' ability to modify rates and their capability to recover certain costs and provide some fair return on their capital. So what are some of the requirements to be to incorporate or implement regulatory accounting? Well, first and foremost is that the regulator must put in place an action for regulatory accounting. We did mention regulator a couple of times. I do want to distinguish that a regulator could be in a different term for different type of utility. For an investor-owned utility or some of the private-owned utilities, for-profit utilities, it could be a state utility commission. That is present in every state. For municipal utilities, often it could be the utility's own board of commissioners, potentially city council, if the utility fund is part of the city or a county, or some kind of other board of commissioners that's a little bit closer to home, if you will, that's independently elected, but still puts rate or approves rates for the utilities operations. So just keeping that in mind, that a regulator comes in different, could have a different face. So that regulator, once the rates have been approved, that's when the regulatory accounting can be implemented by a utility. And generally what it requires is to have sufficient costs built into rates or sufficient revenue coming from the rates that have been implemented to meet agreed upon liabilities of the utility and provide some, once again, reasonable capital, a return on capital. It is important to distinguish that not every revenue stream of a utility falls under regulatory operations. As Julie mentioned earlier, there's some operations that utility may have that doesn't really fall into that rate setting methodology. So for those operations, there could still be deferrals, standard deferrals, we call them standard deferrals, that are present in every company, that in every, any kind of accounting practice could be present. They're just not a regulatory type of revenues and expenses, and therefore there's no regulatory deferrals related to that. The example we have is wholesale power revenue and cost. In some cases, not in every case, certainly depends on the, once again, unique nature of each utility's operations. Okay, so prior, the accounting guidance, as Julie mentioned, establishes a regulatory accounting historically arises from FAS 71. I'm dating myself a little bit, and some of you may be familiar to pre-codified accounting guidance. So that's originally where the some of this accounting comes from, which now is codified into accounting ASC 980, accounting for effects of certain types of regulations. This is for FASB reporters. Prior to 2010, GASB reporters didn't have a specific standard that was related to regulatory operations. In 2010, GASB issued statement number 62, which now incorporates a lot of different guidance from previously issued FASB and NACPA pronouncements, and now GASB has its own standard that it follows. And as Julie mentioned, there's slight differences between the FASB and the GASB implementation for regulatory operations. Not significant though. At the end of the day, it's still the recovery of costs that the utility has incurred to service its customer base. Now, why is this accounting guidance put in place in the first place? What are we trying to do with it? And it's to meet the basic matching principle of accounting, is making sure that the revenues are recognized in the same period as the expenses are recognized. Now, going back to our mentioning of uniqueness of utility operations, the utilities generally take a little bit longer to collect the revenues because the rates are established. There's a time span, if you will, between the time that the rates are established and those costs could be recovered from individual customers in their monthly billings, if you will. And so that could take time depending on how long that period could take. So making sure that we are not under recovering costs, we as utilities are not under recovering costs of operations or over recovering. Sometimes it so happens that our rates establish that we're over recovering certain costs, or maybe planning for future costs that would result in a regulatory liability. So keeping in mind that there could be a regulatory asset and a regulatory liability in the financial statements as a result of regulatory action. All right. The basic debits and credits, we always like to bring it to accounting mechanics and the basics. Once the regulator approved or set in action this regulatory plan, a regulatory asset is recorded, and that incorporates the costs that are being deferred. And generally, it is titled just as such, regulatory asset or regulatory liability. Once again, the liability results from over recovery of costs or future costs that will be recovered or the future costs that the utility will be incurring, or some refunds that the regulator may have required to provide to the customers. The regulatory asset or liability will be amortized into the costs or revenues over time, and there has to be a defined period that the regulator set in place for what period the cost recovery will occur over. Depending on the type of cost, it could take, we've seen some regulatory assets that could be recovered over 5 years, and some regulatory assets that could go as long as 50 years. It really just depends on the type of costs and the utility's ability to incorporate that additional cost into its rates to recover over time. As any other liability or asset that's on the balance sheet of the entity, the regulatory asset and liability has to be analyzed annually for reasonableness, making sure that all of those costs are still recoverable. And if there is a indication that the cost may no longer be recovered, then that expense or that asset should be written off and recognized in the period immediately, rather than continue amortization. And generally, amortization of that regulatory asset will end up in operating expenses of the entity. Or if you are amortizing your regulatory liability, it will be in operating revenues for that customer class from which you're recovering costs.
Olga, just a couple of things, if you don't mind me jumping in here. Just a really good example of this too is balancing accounts, or some sort of a cost equalizer accounts. And so you may have an opportunity, or you may have one that in one period is an asset and another period it is a liability, just by the over or under collection mechanism. And that is perfectly fine as well. It's really looking at that specific of what you're trying to do with that rate, and how that's affecting rates on a period by period basis. The other thing with the time period is that's not always known at the time that you come into these regulatory accounting or regulatory accounts. So you may not know how long it's going to take for you to bring the rates back. Apparently, English is a hard one for me today, Olga. So it's important to note that not every decision has to be made on the date that you have the regulatory accounting. You just have to know that it's going to come in a reasonable amount of time. I will tell you, we had a utility we were working with not too long ago that did, it was an interesting thing because they had set their budgets, and then the rates came about 3 months later, and a budget actually called for a rate increase. And so they deferred some costs. It was some storm damage that was not expected. So they did defer some costs. Everything seemed fine because they showed that they were going to get the rate increase, bring it back into rates into future periods. And then the board got to the point of time where they needed to to make the rate increase, and the board decided they were not going to do something. In fact, they stated in a board meeting that they were not going to raise rates for the next 5 years. That's a good example of where we have to analyze each year for reasonableness and saying, well, no, you said you were going to do it. Now you're not going to do it. Therefore, keeping that expenditure moving and parking it on the balance sheet doesn't seem very reasonable anymore. So think about how different actions the board could take or a regulator could take that could impact each one of these decisions, especially in each year reporting periods, I think is important to think about.
Thank you for that insight, Julie. One other thing I wanted to mention here is that we talk about regulator approving the rates and a rate cases sometimes for larger utilities. If you're going through a utility commission, it's generally a rate case. Important to note that the regulator can disallow some requested rate changes as well. So there have been cases that a regulator had approved a particular charge for recovery and later disallowed it because of certain circumstances or other costs that have been requested for recovery. So there's plenty of examples, particularly in the larger utilities that have to go through the utility commissions, the state utility commissions, where at certain point, even though amount that the utilities are requesting to be recovered through rates is very, very large, the utility commission disallows it, and then they have to take that hit in a period when that decision is made by the regulator. So that's just one of the very important pieces to keep in mind, is that regulatory accounting can actually be reversed or stopped at any point in time should the recoverability of those costs be in question. All right. Generally, when we talk to our clients that are non-utilities, they are very, I should say, jealous or envious sometimes of this interesting mechanism that utilities have access to, is to be able to kind of match the expenses and revenues or defer or smooth out. There's different terms that we have heard with respect to regulatory operations, and as Julie mentioned, other industries do not have that access to the similar type of accounting mechanism. So, but there's benefits and there's also downside to using regulatory accounting. So the first benefit is during a period of extraordinary expenses, in particular, like huge storm hits that we're seeing in different parts of the country, in different types of emergency costs that the utilities incur, those can be deferred to future periods. So thinking about if there is a huge wildfire event, for example, in the West, those costs the utility that's incurring to contain that and then rebuild its infrastructure. The good news is some of those costs could be deferred and amortized and recovered in future periods. The effect of smoothing results of operations to the ratepayers. Once again, the utility is not going to go out to take ratepayers in this very particular moment when it's incurring these extraordinary expenses to experience spike in rates and request the ratepayers to reimburse the utility for those costs right away. So it allows the utility to kind of make those rates more reasonable for its customers. It could reduce the burden on the ratepayers in the short term. It could potentially, the downside, it could increase the burden on ratepayers in the long term. We'll talk about that in the next slide. And then one other area is the debt covenants ratios that could be healthier with implementation of regulatory accounting. Thinking back into the energy crisis in the early 2000s, when the utilities were encountering incredible costs for just purchasing the power to provide it to their customers, and incurring millions and millions and millions dollars worth of power purchase cost in excess of what their normal costs would be. Not expensing all of those costs at the time that they were incurring them and kind of parking them on the balance sheet allowed to to stabilize their debt covenant ratios for those particular periods as well. So that's the benefit of implementation and using the regulatory accounting mechanism. There's also downside, as I mentioned, and the first one, if it's used extensively, it could be very costly and very cumbersome to keep track of every deferral that has been included in the rate structure of the utility, especially if there are different amortization periods, different recovery periods for those costs. It could become, we have seen some footnotes, and we will see some footnotes later in the presentation, that some of those costs are just too many to count for different deferrals. So it could become very, very cumbersome. The one very important point is that the cash flow is really not improved. So if you are experiencing as a utility an emergency event and you need to come up with cash to cover the costs of whatever it is, the emergency that you have, that the regulatory accounting is really not going to be helpful in that situation. And that's where we'll talk about the importance of setting up the reserves later in our conversation. And as I mentioned, the long-term burden on ratepayers could also be increased if we just continue deferring costs and deferring them to future periods to our future customers. That could the rates potentially could just continue increasing at the high levels. Julie?
Yeah, Olga, I was just going to say a couple of things. One, the prior slide where we did talk about debt covenants, I want to put a word of warning. Make sure you check your debt covenants. Every debt covenant agreement is completely different, and some of them throw language in regarding regulatory accounting and how you should use it in consideration of your rate covenants or your debt covenants. So there may not be anything in there, but make sure you take a peek at that before you just assume that it's not in there. So just a good precedents to use. And then second, we got a great question about, can you also defer an extraordinary expense for taxes? That's a fantastic, and it's an interesting question, and it's probably, we're all regulated by different commissions, and generally, so the accounting standards do not say that you cannot use it for taxes whatsoever. However, there's different state commissions, and certain states actually require you to utilize it either on the positive or the negative on the taxation. So there's certain rules in every state. So I would say check with your state commission, see what their protocols are and whether they allow for it. But the accounting standards don't actually specifically talk about state taxes. So something to think about, looking into your state commission, but don't just rule it out as a matter that they can't utilize it. Oh, Olga, I think you're talking, but you might still be on mute.
Thank you again, Julie. All right. So moving on to, there was one more question. Julie, did we answer about the regulators being appointed versus elected?
No, I was going to wait for the next slide since we're talking about regulators on that one.
Okay, all right, sounds good. Okay, technical requirements. The utility, as we mentioned, must meet all of the following requirements in order to implement the accounting treatment for regulatory accounting. Rates are established by a regulator. This is where we talked about utility potentially could have its own board in a form of, if it's independent utility district, it's usually board of commissioners. If it's a fund of a city or county, it sometimes will have its own board, and then the rates could go for ratification to a city council or a county council or some other entity. So the however that board is comprised, the board of commissioners or the city council, if they're appointed officials or elected officials, either one, that entity, that board would be the regulator for that utility. So yes, that the board members, if you will, could be elected or appointed in that situation. The set rates are designed to cover costs, and this is where really a good analysis has to happen when the utility is analyzing its existing rates and considering rate increases, really analyzing the layers of deferred costs from previous periods, from previous rate cases, and analyzing what's already been deferred, what the other periods that those costs have been amortized over, and could we incorporate more of these deferrals into our existing rates, and really keeping track of those layers of deferrals within the existing rate cases. And really understanding that the rates as they're set will be high enough to recover those costs of service, as well as any future planning for the utility in terms of its existing footprint or additional potential anticipated growth in its capacity and needs. Okay, so we talked about rate action, the regulator setting this a regulatory accounting in play. And under ASC 980, that regulator action has to be documented. So it needs to be in a writing of some kind, specifically identifying the deferred costs, the periods when those costs will be recovered over, and what are the amounts that are being deferred. We'll look at some examples here later in the presentation of different types of entities and types of deferrals that they have and how they disclose those. As Julie mentioned earlier, under GASB, the rate of the regulator generally doesn't have to be documented in the same great detail. What we have seen often is that it's documented in the minutes of the Board of Commissioners or Board of the City Council with respect to the rate increases and potentially documentation of the regulatory accounting. We do recommend that that's included in there. However, it's not as specific as it is under the FASB standard. And then once again, understanding the future portion of revenues, future rates are will continue to incorporate these costs from past periods that will be recovered over time.
And Olga, sorry, go ahead.
Just one last comment here. And if there's any costs that we're anticipating into the future that are expected costs that we're happen to be recovering now in existing rates, then those would be recorded as a regulatory liability, as I mentioned before, because the regulator could require a refund of the over collected rates, or the utility could hold them and use them in the future to offset the increases in rates to its customers.
Yeah, and we got a great question too about, are there cases where regulators can be appointed rather than elected? And the answer to that is absolutely. In the standard, what it really gets to is that there's a separate body that is going to approve these rates, and then it takes time to get these rates established into your rate system. It's not by management, kind of like on manufacturing a widget. You can just change the price of a widget if the market allows. We just can't change prices immediately. We need to wait for some sort of a substance to go through and have those approval mechanisms outside who is managing the entity. So I think that's an important distinction, but yes, they can absolutely be appointed.
Thank you, Julie. All right, and if there's no more question at this point, and continue submitting those questions, this is very, very good, and we do appreciate the interactiveness of the webcast. From here, we have the next polling question.
Thank you. Polling question number 3. What types of costs is your utility most interested in deferring using regulatory accounting? A, conservation costs, B, storm damage costs, C, pension OPEB costs, or D, other. For those who would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We'll also be sending them out via email tomorrow, along with a recording of the webcast. And we'll give you a few more seconds to answer the question. All right, here's the results.
Perfect. Oh, we've got a lot of other. It'd be great in the chat if you could throw in, or I guess the Q&A, what some of the others are. So these are the ones we see most typically, I think, through the storm damage. Oh, lead and copper testing. Nice. Yeah, I've been doing some work on that one too. Storm damage is obviously one that's just been hitting. I think we're in the midst of between hurricane seasons and fire seasons, and they just don't end. Pension and OPEB tend to be more on the GASB side, and we'll talk about those in just a second. But great ideas of how you're utilizing the regulatory accounting in this accounting vehicle. So let's talk about some common applications. And these are just common ones that we've seen. You know, Olga and I have both been in this business. I think we're well into our third decade. That's scary, Olga, but third decade of in utilities and accounting. And, you know, when 20 years ago, 30 years ago, it was very much, you know, storm damage and very specific cases. Now we're seeing a whole lot more uses and a lot of more, I guess, creativity in how you're utilizing regulatory accounting and making sure we're staying in the constraints of it. But these are just some common applications that we've seen. Now, again, I'm going to remind you, especially if you're regulated by a state board, make sure that you go check that state board of the commission, because they may or may not allow certain uses of regulatory accounting. So the state boards can be more prescriptive. We're really talking about the entirety of what the FASB and GASB are saying. So just some ideas: unexpected storm damage, rate stabilization, unexpected power, other utility costs. Note that we're utilizing the word unexpected. If you're expecting this in your rate stream already, then you can't already, if it's already in your rates, then you can't utilize regulatory accounting. This is also somewhere we've seen utilities get hit pretty hard. We did just see one, when I say just, it was about 10 years ago. What we saw a very large project that was actually pushed down, and the utility commission did not allow for it to go through. And a lot of the preliminary costs go through because it wasn't included in their budget. It wasn't included in what their plan anticipated, and the commission thought it should have been. So there's definitely times where the commissions can say, no, you should have been able to expect it, that you didn't do what was right, or what they thought that was right. Therefore, they're not going to allow recovery of those. Then the OPEB and pension, that's one we'll talk about. We've actually got a whole slide on that one, so we'll talk about that in just a second. All right, so let's just talk through a quick power cost case study, because this is probably the unexpected storm damage is what we see all the time. Now, every utility out there has got storm damage in your budget. You're going to have to, because it's just, I mean, whether it's embedded within your maintenance expense, it just is something that we have to deal with everywhere across this nation. But what happens when you have that 10-year, that 100-year storm, something that is just outside of what you're going to collect in your normal revenue stream? Well, what do? You take a look at it, and if it's not recovered through other means, what I mean by that is if you have storm damage that is excessive, and it does get recovered by FEMA, then just if it's recovered by somewhere else, it doesn't get to come into your rate stream. So make sure we think through that. But let's say there wasn't a FEMA event, or you had additional costs that you're not going to get recovered. It's not sitting in your rate structure. Your cash flow is going to be too lean. If you don't utilize regulatory accounting, what do? Well, let's just take it that it was $1 million. So our original entry, if we would have booked this, because we got to love our debits and credits, we would have recorded either maintenance or storm expense, some type of operating expenditure of $1 million, and we would have credited cash, because the cash has got to go out the door as the storm is dealt with. So when we make the decision to go ahead and recover that, and we get approval from the regulator, whether it's your board of directors or a commission, what you're going to do is you're going to back that thing out of the income statement. So you're going to go ahead and credit that storm expense, and then you're going to debit your regulatory asset account. Then you're going to take a look at the time period in which it's going to be put back into the rate structure. So if your regulator said that you've got a 5-year deferral or a 4-year deferral, then you're going to go ahead and bring it back into your expenses over time. So you're going to amortize that regulatory asset to storm expense as that recovery occurs. So as you put it in your rates, you're getting that cash flow as revenue through your door. You're going to go ahead and bring it right back into storm expense. So that's just the most probably common, easy one. The other thing I want to make sure to note is just because of 1 year you might have a storm damage and maybe you have the exact same storm or similar storm the next year, this is a case-by-case decision-making basis. So you don't have to defer or utilize regulatory accounting. Obviously, if your regulator tells you to do it, you got to do it. But you don't have to utilize it from year to year. We've had situations where there just may have been other causes that you've had excess revenues. Maybe you had a really cold winter. Maybe you had excess usage for other reasons. And you could take on that hit in the current year and still have sufficient operating results in the current year, and it not going to affect your cash flow that you need that rate to come back. Then you don't have to use it. Just because you set the precedence in the prior year or years before doesn't mean you have to do it again. But again, just because you didn't utilize it in a storm before doesn't mean you can't utilize it again as you look at your current situation. Now, again, check with your state commissions because there are standard deferrals that many states do allow, and storm damage is usually one of those. Okay, let's talk about rate stabilization and reserve case studies. Reserves are an interesting thing because whether or not you can utilize it, make sure to talk to your service professional because this one can get in certain situations like cooperatives. There's certain situations you have to think about patronage capital and how are you going to affect rates from that perspective. But if you can utilize it, let's say that you have you've got too much revenue in a single year. We had a client not too long ago that had an incident with one of their generation facilities and it went down. So they were able to sell some of the gas that were bringing to this plant. They were able to sell that in the open markets it was a very lucrative contract for them. So rather than just giving that straight back to the ratepayers because they realized that they were going to get a big chunk of money in a current period, rather than give that money back, they reserved it and they went ahead and made sure that they weren't going to increase rates for a period of years. So if you do have revenue that's in excess, and I will say this is not as common as we see expenses probably 9 times out of 10 over this type of a reserve. But again, I think it's important to note that this can be utilized under the standard. So the original entry, when that cash comes through the door, you're going to debit your cash or your AR, you're going to credit your revenue. And again, you just reverse. When you make the impact and you make the decision to utilize regulatory accounting, we take the income statement impact off the books, throw it onto the balance sheet. So it would be a regulatory liability in that case. And then as you bring that back into your rate base, you're going to amortize that back to your revenue stream. For any cooperative that is on the call, some of the things to think about here, again, your patronage could be problematic, but then this isn't just for the co-ops, for everybody too, is to think about how your rate classes. So if you're taking the regulatory reserve out of a single rate class, making sure that you bring it back to benefit that rate class. So there's definitely things and obstacles we've got to get over, but it is something that we have seen utilized. All right. So the non-cash has been probably the most interesting one we've seen here recently. This is primarily because it was quite honestly, it really kicked in when GASB started their pension and OPEB standards. So if you aren't on the municipal side, you haven't had to deal with these standards. But essentially, we're starting to put these huge liabilities and obligations on the books. And the hardest part from a rate making perspective is that we're putting an expense on the books today that may or may not be paid out for the next 30, 40 years. So there's a massive gap where traditionally in utilities, we didn't have this big of a gap. There's a massive gap between when we make the cash payment to when the expenditure gets on our books versus when the cash payment goes out the door. So we've seen several municipal utilities utilize this standard to make it so that their income statement, so they still record the full obligations and the full liability of the pension and OPEB. We don't get to change that part of the standard. But what it does do is it makes it so you're matching your expense accounts, your pension expense or your pension benefits, you're matching those to the actual cash flow that's going out the door. And the difference between those two, so the difference between the change in your obligation and the cash flow that goes out the door is your regulatory asset or liability, and it can flip either way. just depending on the accounting mechanics of it. This makes a lot of sense when you look at rate making for a lot of our municipal utilities because they want their rates, they're looking at their debt service, they're looking at their rates on a cash basis, not on trying to do this accrual that has a lot of impact to it. So again, when we look back, what we're doing is we're saying we're going to still book the OPEB liability or asset, if it could be, or the pension liability. What's going to be booked onto your income statement, if you utilize the regulatory accounting, is your cash flow, so the actual cash that's sent out to the program. And then finally, we're going to go ahead and whatever that difference is going to be our regulatory asset or liability. At the very end of the program, it will equate out to zero, but I will tell you at any given day, it's just going to bounce back and forth. A lot of our clients this has been very helpful, especially for a lot of the standard. We didn't expect such big variances on the income statement, but we definitely have seen it, especially in the last 10 years. So example, pension and post-retirement benefits, vacation accruals are another one we're starting to see pop in there because you might have some long-term vacation accruals. We don't see that as often. We have seen it. We don't see it quite as often as we get our pension and post-retirement employee benefits. Olga, is there any questions from that perspective? Slow down.
Nothing specific to that. There's one question related to, was asked, were utilities using this regulatory accounting for the few months last year that the natural gas prices were crazy?
Yeah, well, some of them. Again, it really depended on what the individual utility budgeted, how much their use of the natural gas was. We saw the standard utilized a lot in Texas when the Texas storm a couple years ago hit. We saw it used in the early 2000s when the power crisis across the Northwest hit. So we're seeing it utilized time and again for certain situations. But yeah, that's a perfect example of when things are like, oh no, what is going on here? We don't have this in our rates right now. We need to accumulate that cash at some point in time. So absolutely, it was used.
Julie, one more question. Are asset retirement obligations used in this non-cash items, and how are utilities collecting those in rates?
I feel like that's a trick question, Olga. Are they? Yeah, that is definitely something that can be considered depending on how you have it funded in your rate structure. And I think it's utilized more commonly because we don't have anything funded in our rate structure outside of nuclear. So the only program I shouldn't say only, different states have different requirements as well, but the feds have a requirement to fund to the nuclear trust a certain amount of nuclear programs. So we see that funneled in the rate because you need to grab it now. I would say that the answer back to you is it really depends on what you're going to do as a utility to fund that ARO. The standards under FASB and both FASB and GASB do not require funding. So that is a business by business decision. And I will say still to this day, we tend to push a lot of those costs way down the pipeline because it's not something we got to deal with today. So it really depends on are you going to start reserves for those. So there's a lot of conversations about starting reserves for those kind of asset retirement obligations, starting potential trusts for those retirement, especially when you're looking at some of the coal facilities, the nuclear, those types of facilities. But I will say I certainly haven't seen any cash reserves established for that for our wind or solar or our hydro facilities at this point in time. So again, those costs can be deferred if they're not in your rate stream. But someday we're going to have to figure out how to get those costs into our rate streams, because the last thing I think we want to do is get to a point where the asset is out of service and then we put it in our rate stream, or having people that aren't benefiting from that power or the water, whatever, affected by it. It's a good question. All right, I'll move to the next slide then. This is I think I already talked about the vast majority of this, but reserves can be an effective tool for utilities. We do see reserves on the municipal side quite a bit more, maybe on the investor-owned utility than we do on co-ops. But it can be an effective tool for protecting assets and smoothing the effective rate increases over time. But again, there are some problematic areas in the sense of cooperatives, not that you can't get over them, but something that we want to consider. They're definitely a tool. Now, again, it's interesting because we still see times where reserves are utilized and we still have lots of regulatory accounting. This regulatory accounting can get really messy if you have a ton of them. There's a lot of organizations that you'll have a single accountant, full-time job, just trying to match and monitor and making sure all these accounts are taken care of, if not multiple accountants doing that. So again, reserves, it can be a good tool, but it's just one of the other tools in your arsenal. And make sure that we understand, what the effects on patronage capital for any cooperatives out there, and then making sure we truly understand the fair and equitable nature between your rate classes, because that's the area that can get you into trouble. Okay, Olga, I'm going to turn it back to you.
All right, thank you. So this is more of a kind of a word of warning, if you will, where regulatory accounting is overused, it gets out of control, if you will, is when utilities start to just defer everything because, to make their financials look better and really not thinking about not tying these deferrals to the rate making process. It's really one of those exercises where at the end of the year, you can't just say, oh, this pool of costs, it's too large. We don't want to expense it. It's we'll recover it at some point and just park it on the balance sheet as a regulatory asset. It really doesn't work that way. And in a utility environment, the getting your rate approved or rate case approved, if you go through the utility commission, it takes some time. So making sure that approval from your regulator has been obtained before setting up that deferral item is very, very important. So now identifying costs that potentially could be presented to the regulator for approval for regulatory accounting treatment is certainly appropriate throughout the year. But at the end of the year, when you are truing up your regulatory assets and liabilities, really need to be cautious about what can be deferred and what cannot. Sometimes we see that utilities defer certain costs and really don't think about the amortization period, or maybe amortization period was set a few years back for a particular regulatory item and it has changed, but it never was updated. So that amortization just kind of continues going on. And sometimes we have seen where regulatory items just continue amortizing indefinitely without specific kind of stopping points. So we have seen an interesting example of that. But the biggest word of caution is that there are deferrals that could become very, very cumbersome for the utility to keep track of, because as we mentioned earlier, each layer of deferral or each cost pool would need to be recognized or analyzed separately in each rate case. So just keeping track of all those deferrals could become sometimes cumbersome and time consuming.
Hey, Olga, I just want to mention two more things before we get on to the disclosure examples. One, a unique one that came up, and this is really on the GASB side, not on your FASB side, but when GASB decided that capitalized interest was no longer allowed to be completed, we've had several utilities that have actually utilized regulatory accounting to capitalize interest. So it's an interesting kind of on the creative side of the use of regulatory accounting. And then one question just came down regarding the use of regulatory accounting for the pension, that in a certain situation where it was set up as the initial liability. So in the first year we had to do this, it was just a huge obligation that showed up on your books, that they utilized it for that, but can can we use it annually as well? And the answer is absolutely, if your rate structure, if you're going off of cash. So if you are utilizing, you're paying it out in cash, or you're matching your rate structure, then you absolutely can utilize it. So it'd be the difference between what you paid out in your cash to your trust accounts versus what was the difference between what the reporting, when GASB says you need to record as expense, can be set up as a regulatory asset. So absolutely it can be utilized if your rate structure is on a cash basis for pension accounting.
Thank you, Julie. All right, well, we talked a lot about kind of theory and what you can do and some of the accounting mechanisms. We also wanted to provide you some examples. Now, a disclaimer here, the examples we pulled are from an investor-owned utility and from a municipal utility. Both annual reports are available on those utilities' websites. So we're not the auditors for either one of these utilities. So we really just kind of wanted to provide you some independent examples of what some of these larger utilities defer in their regulatory assets and liabilities. Also, a disclaimer, I cannot even read this particular table. So this was just more of a visual of the volume of some of the deferrals that utilities have. If you are interested specifically in looking what those layers of deferred costs are, you can once again go to those financial reports that are posted on these entities' website and really look into specific items. This was more of a visual for looking at the extent of the disclosures that would need to be included in your annual report should you have a regulatory asset and liability. For Avista Corporation here, they include the information on a remaining amortization period, what's included as returning earning a return or not earning a return, expected recovery or refund, and then of course the balances for current year and prior year that matches their financial statements. Those little bullet points at the end of this particular table, and actually a couple of pages that follow this particular table, really describe in great detail of some of the costs that have been incurred, what was the regulator action that triggered deferral of those costs, and what are some of the amortization periods that the utility is using to amortize those costs. Now, some of these, this particular second line item down includes pension and other post-retirement benefits. Avista also has line items that relate to utility plan that has been abandoned, specific to their change to AMI project cost, the automated meter reading infrastructure. They have COVID-19 deferrals that have been approved by their state regulators, once again, their state commissions. So all of that information is included in their footnotes and really clearly outlined. So that's one for Avista. Another example we have is for Los Angeles Department of Water and Power. This is a municipal utility. Their regulator is the board of commissioners of the utility itself. And then the rates get approved by the city of Los Angeles City Council as well. Once again, small table, but what this table presents is the roll forward of their regulatory assets and liabilities, starting with the previous year, the balances that were recorded. What are additions? What are some of the retirement/amortizations? And then what is the balances that are in current year? Once again, a long description of what those individual line items follows that table. And so just keeping in mind, if you do enter into regulatory accounting, the description and disclosure requirements are also extensive for upkeep in your annual reports.
Right. And I don't think we have any additional questions, so I think we can move right to the final polling question. We got you all the way to the end.
Oh, great. Thank you. Final polling question number 4. Are you interested in additional information about implementing regulatory accounting at your utility? A, yes. B, no, C, maybe in the future. Once you have completed all CPE requirements, you'll be able to download a PDF of your certificate from the CPE progress window. And we are aware that it does have the wrong date, so the corrected CPE certificate will be sent in the 2 weeks following this webcast. All right, and here are the results. And we're just going to thank Julie and Olga for a great presentation today. To our audience, if you have any further questions or comments, please reach out to us, as we will be happy to continue the conversation. You could drop a note in the Q&A window or reach out to Julie or Olga directly. Their contact information is in your console, as well as the slide deck, which you can download now from the handouts window. Finally, here is a survey for today's presentation. Your feedback is appreciated. Thank you again for joining us. Take care, everyone.